How's it going?
Good. We did some pretty serious conversation last time, so I wanted to just cut to the chase and get right into things. You left off on the moment you nearly threw in the towel. That had me captivated. I wanted to talk a bit more about that too. You mentioned that at the time, primarily what influenced your feeling that way was that you thought that retail traders couldn't really have any success in the market when all brokers out there apparently seemed to not be serving their interests before their own. And that led you to conduct more research. And you eventually found Darwinex, and that changed your perspective a bit. We also talked about the Brokernomics series that you mentioned in your own view, considered an essential back when you started, because there was very little in the way of in-depth or quality content available at the time to give you a better understanding of how brokers actually work.
Yeah, that information wasn't available, and it was because of that, my understanding was lacking at that time. So I didn't really have any of that in-depth understanding, and it would have been great to have that at the time. And, it's a great resource. I think every trader should watch that to get that full understanding of who they're actually dealing with when they deal with their broker.
Yeah, I'm really happy you say that, because if there's one thing Juan was adamant to do, it was we absolutely must get the full scope of detail and simplify it as much as possible so people have a very good idea of what brokerages are all about and how brokerages should treat clients. And it's our way of leading by example rather than just listing facts on a sheet somewhere. You hit on a point which I'd like to continue on today, which is especially essential for anyone who's looking to have trading as a career. Mm-hmm. So now this subject, this subject is chock full of positivity as well as taboo and lots of scarring, if I think you'll agree, in the industry, primarily due to various marketing practices, mostly questionable, that have led to traders, particularly in the retail sector, forming expectations that are well beyond reach. Would you agree?
Yeah, for sure. I mean, a lot of people, I think, go into trading initially based on a misconception about what it will actually entail. Mm-hmm. And to a big part, I think that misconception is driven by, things that people post on social media. They're trying to play to people's emotions, I mm-hmm. think. So this, the one that always stands out for me is one that I saw many, many years ago, which was a brief video of this guy who was sat on his beach with a laptop on his knee. And he was, purportedly trading for half an hour a day and living the dream lifestyle.
Those are classics, aren't they? There's plenty of those around, unfortunately. Yes.
I don't tend to I don't look at these things anymore. They're just complete nonsense, because that is a million miles away from reality, and people need to understand that. And this is not. I guess the first thing is that, trading it's a difficult endeavor. I've said this before. It is difficult. And that's actually a good thing, because if it was easy, then everybody would be doing it and there'd be no edge left in the market. Okay. So the fact that it's difficult, I look at as a positive thing, because yes. If you can strive, what you need to do as a trader is to strive to get that edge out of the market wherever you can. Mm-hmm. And the fact that it's difficult is a good thing, because it means not many people, are able to do that really, really effectively.
Sure. Yes.
So yeah, it's there you go. That's my view on that myth, if you like, of
yes. I think it's important at this point to state for whoever is listening that trading as a career is very much something that exists. But the way it's been purported is prone to leading people to form really unachievable expectations, or form opinions of trading as a career as something that is full of some sort of limelight or some sort of glamour that is really a complete, whatchamacallit, misrepresentation of what trading as a career actually entails.
That's an important point, actually, that you made there. It's all about going into it with the right mindset.
Correct.
Okay? So if you go into it with those preconceptions that I will be able to trade on a beach for half an hour a day and live this wonderful lifestyle, clearly those expectations are not going to be met. And those people are going to become disenfranchised and leave trading. However,
exactly.
If those same people, go into it with the right mindset, then they have an incredibly good chance of becoming successful.
Absolutely. And that right mindset is something we can talk about in brief here and elaborate on in future podcasts. Like the right mindset for somebody who's considering trading as a career should really start with whether you've been able to, over time and effort, generate an alpha that you found is robust and scalable. Would you agree that that is really the starting point prior to anybody even potentially considering trading as a career?
That is one of the critical sort of fundamental things that are required, because if you can't generate alpha from the markets, then clearly, or you don't have an idea of how to generate alpha from the markets, then you can't do anything else. Okay, you've got to have that idea as the fundamental starting point.
Let's take this moment to step into the shoes of somebody who's just started out in trading. Let's revisit our past selves, for instance. Individuals who form expectations or are susceptible to, for instance, marketing practices around trading as a career, questionable marketing practices, tend to come from various different backgrounds. But the thing in common with their experience is that they've just started treading the waters in the financial markets, and based on what they see, there is opportunity galore. For instance, just taking a look at a price chart in a certain format versus another is prone to creating expectation itself. For instance, the same euro-dollar chart, when visualized as candlesticks, has a completely different impact than would, say, a line chart.
So you make an interesting point there about psychology and the way that we perceive reality in terms of whether it's looking at a chart or looking at some other information. And the thing that always sort of jumps out at me as being a prime example of that is if you just put a couple of moving averages on a chart, okay? And if you just look at the crossovers and you look at what the price action does as the moving averages cross over. So, for example, the short-term moving average crosses above a longer-term moving average. And you just look at that information, and certainly if you look at that on a line chart, you're going to instantly think, wow, I'm going to have a really great system from this.
Yeah, it's very powerful.
Yeah. You think, gosh, how could I possibly lose? And of course, as soon as you then develop...
And had I done this for the last 13 years that I see it?
Yeah, but what you realize is that when you actually start to trade that or develop an algorithm to act on that, the results aren't quite as good as you thought they were. And when you sort of get into the devil of the detail around that, you notice that things that were causing the crossovers were actually the highs of bars, which means that when you visually look at the chart initially, your brain tells you you're getting in at that low price, okay? But you're not, because the thing that caused the crossover is the fact that the price has already gone up and you have a high on that bar.
Correct.
This is one of the real sort of psychological illusions, if you like, that can affect a trader's, ability to interpret that data properly. And as soon as, and the converse is true, you might have an upward trend for a period of time, then price begins to decline, the crossover happens the other way, and then it's exactly the opposite. The brain tells you you're getting out on the high of that bar, but you're not. You're actually getting out on the low. And when you compare the high that you got in with the low that you got out, actually, there's not as much edge in that move as you had first sort of perceived from just viewing the chart.
Very true.
That's the example I sort of use in terms of, not really, or the chart, if you like, fooling the brain into thinking there's a really great edge.
At the bare minimum, in order to even comprehend trading as a career, one needs to have an edge that they can scale. That's where this whole conversation of trading as a career really begins. And in the industry, there are several notions, several misconceptions about trading as a career, driven primarily with leverage, all of these marketing materials that present trading as a career, that if you have a wonderful edge that backtests really well, then employing this kind of excess leverage can yield this kind of financial glory this many years down the line, for which price data doesn't exist.
Would you clarify on one point there? Because
go on.
You talked about this scalable edge, and I think I know what you mean, but can you just provide a little bit more detail about what
good point.
you mean by a scalable edge?
Absolutely. So it's important to understand that an edge isn't simply something you can throw all the money in the world at. There are different kinds of edges that have different kinds of scalabilities. And what does that mean? That term scalability actually refers to how much capital that edge can actually handle. Let me give you a concrete example here. Okay. So you say you've got a night scalper. You're trading at illiquid hours, let's say. You trade on some asset during some range of, some hourly range in the Asian session, when liquidity is thinner than it would be during the European and American sessions. And this particular strategy of yours, this night scalper, looks for very small moves, such as a pip, 2 pips, anywhere up to 10 pips, let's say, for example's sake. Because of the combination of price movements that strategy looks to capture, the times at which it chooses to trade being not as liquid as others, and the potential for that strategy to experience extremely different results, were there to be variation in the bid-ask spread, were there to be variation in liquidity, further variation in liquidity in those times. All of those factors will influence how scalable such a strategy is. And because it's not looking for very large moves, it's likely that it's going to be, it won't be something that can be scaled, meaning it cannot possibly handle too much capital in practice.
Okay, so basically you're saying, trading in that way, using that style, might be fine for an individual trader who is only, putting a small amount of capital into those trades. But I guess what you're coming on to here is the fact that if that trader at some point in time wanted to pursue third-party investor capital, that would completely change the scenario.
Absolutely. The reason that would happen is because of all those restrictions or constraints, as I alluded to earlier, looking for small price moves during thinly liquid hours, and looking for example, that particular range of time isn't the best for certain assets, but it is for other assets that are more specific to that session. So all in, a night scalper is probably not going to be the most scalable strategy. And why that is important is that before we get to the argument of how much capital we can raise for it, typically new to intermediate traders will fall prey to this in backtesting rather than in actual forward testing in live trading, because there are backtests galore everywhere, scattered on the internet. This night scalper, were you to deploy $100 as starting capital to this and employ insane leverage of 1 to 500 or something like that, you would arrive at billions or something, some very interesting number like that. And that is so far from reality, because what would happen in practice is that strategy's capacity to handle more capital would probably level out at $500,000, beyond which that strategy would fast turn into a losing strategy because the spreads would kill it, or the
slippage as well.
Slippage.
You get slipped because under low liquidity. It doesn't take much
to slip a trade at that time. Yeah. So these are some of the misconceptions around scalability that I'm glad you asked me to describe precisely what I meant by scalability, because scalability isn't something you can determine from static backtests. What you can do is form an impression about the potential scalability of the strategy through a mix of two things: common sense, as well as treating the backtest with additional tools that give you a better estimate of that scalability. So common sense would be what we just talked about. That right. So can I really foresee deploying so much capital to this night scalper that is looking for these tiny moves where lots as far as 1,000, 1,500 lots have been traded on a per trade basis? Would I really in practice ever be comfortable with pushing so much capital through one position that is targeting a pip or two? Would I be able to absorb the real-time drawdown that I see in this backtest when there are 1,000 lots open on that position? And there's some common sense things we can think through when we are looking at these backtests to ascertain how realistic they are. And
and I think that comes back to the psychological conversation we had as well, because when people come across those things, if they don't have that full understanding like you've just described, those backtests can just appear to be incredibly appealing, and it can draw people in because of the feelings that evokes in someone's own mind.
Absolutely. Probably well intentioned too, actually, because everybody aspires for growth in some form or another.
Yeah, of course, but it's only that true understanding that makes you realize that is that is not a reality.
Absolutely, totally agree, and I think it's also to do with the kind of growth we're talking about here. Financial growth can be misled quite easily because it's a very strong emotion. Not that I'm a psychologist, but I've experienced this emotion. Yeah. It was for me in my earlier days, and it probably, I would say, in hindsight, a lot of my unforced errors were due to these emotional reasons, these particular emotions invoked by what you just described.
And I don't think there's any trader who would say that they didn't fall into that category as well when they first came into trading. So
yes, and if you come across anyone who does say that, don't listen to them. No, it's very unlikely that that's going to be true unless they are humanoids from the future, which we're not far from, actually, given the way Boston Dynamics and Elon Musk are going. I reckon we'll we'll be talking about humanoids a bit more seriously in some years' time. And not to distract from the subject, but essentially coming back to the trading as a career theme, all of this is really, really important, because if you're going to consider trading as a career, you will absolutely need to first have arrived upon a scalable edge, not an edge that you can backtest using completely unreasonable lot scaling, for example, or order sizes, but arrive at a scalable strategy that you foresee benefiting from extra capital. But prior to being able to ascertain how much capital it can handle, you need to estimate this as closely as you possibly can.
Yeah. Well, as you know, Ali, one of the the series I've recently done on the YouTube channel is around the investable attributes. One of which, of course, is the capacity.
Yes, I saw it. Very well executed, Martyn. There is a huge advantage that the Darwinex platform provides its traders in that it gives traders metrics to ascertain how investable their strategies are, even by themselves. Not necessarily through third-party capital. I think it's really important information for one to know how much one can invest in their own strategy before we even start thinking of third parties. Would you agree?
Yeah, it's a good, very valid point. Yeah.
Yeah, and that it determines how much capital you yourself can deploy to your own strategy before you can even think about going outside your own boundaries.
Which then, of course, informs that decision about becoming a trade as a career. So, And the message I was trying to, I guess, get across there is that, a lot of people historically have seen those as being metrics that help to inform investors about where to place their capital.
Yes.
However, one of the things that I get from those is actually you've just used a great example where traders of the systems themselves can get vital information. The example you used, get an idea of what the capacity of your trading strategy is in reality in order to attract that investor capital. And that's, I guess, that was the overriding message across all of those videos that I produced, was that these aren't just for investors. Yes, it's, really useful for investors to perform their own research about where they might want to, put capital, but more importantly for me as a trader is that they provide, vital intelligence about the areas that I need to improve, because it highlights those potential pinch points and those problematic areas for me.
At the end of the day, if it is a scalable strategy, then trading as a career can be approached in a sensible fashion, not through excess use of broker-given leverage. The other option is to list your trading strategy at Darwinex as a Darwin asset, where you have the broker, Darwinex broker, as your execution venue, and you have the asset management arm of Darwinex doing all of those infrastructural and regulatory things for you that you otherwise would incur a tremendous cost doing yourselves. So trading as a career, in summary, must not be approached with broker leverage and unrealistic backtests in mind. It should be considered once you have a good handle on whether your alpha or your trading strategy that you've seen success with is scalable or not. And the only way you can actually find out is if you link your account at Darwinex and continue your journey here, whereby Darwinex's platform tools can tell you what your capacity is.
I think, Ali, there's a point we may have sort of alluded to, but not categorically said here that I think's worth raising.
Go for it.
Which is this, we're talking about this subject of trading as a career, and you've rightly mentioned the fact that traders are often, they're faced with an option. It's either to use excessive leverage or to maybe, pursue additional third-party capital in order to get that. But I think the point we've maybe missed is that why those are the two options that will make trading as a career a viability. And for me, it's because of trading capital. Okay, so we can't speak for every trader out there, but generally, I would say that retail traders tend to have a fairly low amount of capital available to them for their trading endeavors. And the point there is, if you let's say you have an edge, a really great edge that is possibly going to return 20%, 30% per annum. Okay. And, it would need to be a good edge for that. Then in order to make enough to trade for a living means that you need to work out how much you need to live, first of all, and then you need to work out what your capital needs to be in order to return that level in order to do that. And what you have to remember is that when you are trading for a living, for a career, you're going to be taking money out as well to live on. And that's important because that will reduce your trading capital as you go on. And so again, this alludes to the backtest you talked about before, whereby that assumes that you're not taking any money out at all.
True. Again, a very unrealistic thing to model in your backtesting.
Exactly. Now, as soon as you start to do that, you would not believe the impact that has on an equity curve. When you take regular money out of your trading capital account, that has a big impact. And so the point that I really wanted to make is because of that, that is why traders then are faced with this question of, okay, how do I move forward? And usually the two options are use leverage to an extent that becomes dangerous to your capital. Because, of course, if you over leverage, the chances of destroying your trading account increase exponentially. So let's for now say that option is incredibly risky. Okay, and it's putting your trading account at a lot of risk. And so that then leads on to this other option that you were talking about previously when we were talking about capacity and the capacity to be able to cope with investor capital in that for that strategy.
No, that's a good summary of my blabbery. You're always able to distill things into much simpler terms, Martyn. Even your conversations with me sound like one of your tutorials on YouTube. I'm like, well, Ali, we missed a point. It's like, gee, thanks. No, I really mean that. It's always very refreshing.
So an additional point I think that I would like to talk about next time is that about implementing some kind of structure to your trading endeavors. So if you are going to treat, trading as a career, that's something that I feel is vitally important to have that structure and the processes in place, or the methodologies, if you like, in order to promote the best kind of environment to make this a career choice. So there's quite a lot about that I think I'd like to go through next time, Ali.
Sounds great. Always a pleasure having you structure something to talk about structure, Martyn. All right, then. I think we've shared quite a lot today, so we'll call it a day. But as Martyn said, next time we're going to dive a bit deeper into how to structure your process before embarking on anything remotely close to trading as a career, because it's extremely important to ensure that you're well prepared for that, rather than just jumping in without organization.
Yeah, absolutely.
All right, my friend. Thank you very much for your time. I'll catch you again in the next one.
Cheers, Ali. See you, mate.
Cheers,
Bye
Martyn.
now.
See ya.